Welcome back to the Deep Dive, the Talk Ticker segment, where we really get into the latest earnings calls. We stack up the research, cut through the noise, and hopefully give you some clear insights.
Yeah.
Today, we are focusing entirely on PT Bank Mandiri, that's ticker BMRI, and their Q3 2025 earnings call.
Yeah, and this one's pretty critical, actually, because BMRI, well, it sits right at this kind of intersection. You've got really strong operational performance on one side,
Right.
and then heavy government influence, policy pressure on the other.
Right.
We saw that tension play out almost immediately in the market reaction.
How so?
Well, the stock popped right after the call finished, a signal that the operations looked good, but then it faded pretty quickly in the next trading session.
Right. I think that's the real story here, isn't it?
Yeah.
It kind of suggests investors look past the headline numbers, maybe saw the initial good stuff, but then immediately focused on the core challenge.
Yeah.
Which is that Mandir's management is, well, they're juggling. They're navigating some really intense policy pressure, specifically around using that big government liquidity injection and, let's be honest, the sort of implicit mandate to lower lending rates.
Exactly. So our mission today for you is to really cut through the management speak. We want to clarify the key levers they're actually pulling to try and defend profitability.
And figure out if their strategy, which seems to lean heavily on like funding tricks and their digital platform, is actually sustainable with this policy stuff hanging over them.
Precisely.
Okay, so let's unpack it. Starting with the numbers themselves. Looking at the first 9 months, the 9M25 period, top line net profit was Rp 37.7 trillion. Yeah, and we should probably point out this is actually a year-over-year decline. It's down 10%. So if profit's down, what drove that initial positive reaction before the fade?
It really came down to the quality of the underlying performance. I mean, their execution was just better than the overall system. You saw basically three big pillars of strength.
Okay, like what?
First, loan growth. Consolidated lending was up a strong 11.0% year over year. And you got to put that in context. The whole industry system loan growth was hovering around, 7.7%? Yeah. So Mandiri's really outpacing the market there.
Okay, so robust growth, that's good. But, keeping margins healthy when there's pressure to cut loan rates, that's tough. What about their net interest margin, their NIM?
That's pillar number 2. Resilience. Their NIM, year to date, held up at 4.89%. And critically, that's smack in the middle of management's own guidance for the full year, which was 4.8% to 5.0%.
Still within range, okay.
And the third thing is asset quality. Their risk management is genuinely best in class. The bank-only non-performing loan ratio, the NPLs, it's tiny, 1.03%.
Wow.
Yeah, compare that to the industry average of about 2.28%. It's extremely favorable.
So it's kind of a paradox then, right? They're beating peers on lending, growth, risk, but the bottom line, the profit is actually resetting lower. It seems pretty clear the policy environment is forcing them onto the defensive. So the whole story shifts to, how do they defend that NI? Let's tackle that head on. How did management keep that NI at 4.89% in Q3?
Right. It was basically all about managing the cost of funds, the COF. That seems to be the only variable Mandiri management feels they can really aggressively control to try and offset that external pressure on loan yield.
And that big government liquidity placement played a role.
A huge role. They confirmed the significant immediate benefit from that Rp 55 trillion placement. That was like the central theme of the call, really.
Okay, Rp 55 trillion, that's a massive amount of liquidity. How exactly did they deploy it? And maybe more importantly, how did they use that to protect margins?
Okay, so they reported about 70% of that placement has already gone out as loans. But here's the really crucial bit, the kind of clever move, maybe.
Yeah.
The cost of the unused part of that government money is really low. It's around 3.8%. So management got strategic. They used this cheap 3.8% liquidity, almost as leverage, to actively push down the price or reprice their existing wholesale deposits that were costing them more.
Wait, hold on. So they didn't just use the cheap government money for new loans. They actually used its existence, the cheapness of the unused part, to kind of muscle down the interest they were paying on their existing funding, like replacing expensive old debt with this cheaper government cash.
That's exactly it. They basically went to their wholesale depositors who were getting paid more than 3.8% and said, look, we've got this cheaper option now, effectively forcing them to accept lower rates. And that mechanism drove substantial savings.
Ah, I see.
It explains why their cost of funds dropped down to 2.33% month to date in September. And that COF reduction is pretty much the single factor holding up the NIM against that loan yield pressure. Their average loan yield was still holding around 8.21% month to date then.
Okay, that is a clever tactic. But it brings us back to that challenge we mentioned earlier, right? Sustainability. That RP55 trillion placement, it's not infinite.
No.
So what happens when that liquidity runs out, or if the government pushes even harder on loan yields? Are they just sort of kicking the can down the road here?
That's definitely the sort of longer-term anxiety hanging over the stock and management. They know it. That's probably why their LDR, the loan-to-deposit ratio, is being kept pretty disciplined, around 93%. They're trying to maintain a balance.
Right.
They also mentioned their NSFR, that's the net stable funding ratio, measures long-term stability. It's decreased slightly down to about 110%, which is pretty close to the bottom end of its range, around 109% seen before. So yeah, they're balancing immediate cost savings with trying to maintain long-term stability.
Okay, so if that strategic funding optimization is, let's call it lever A in their defense, what about lever B, that digital moat they've been building? This feels like where Mandiri tries to shift from just being government influence to being a tech player.
Oh, absolutely. The Livin app. It's not just an app anymore. It's a genuine strategic asset.
Yeah.
And probably the sustainable answer to that funding puzzle long term. The metrics are just, well, they're overwhelming.
Give us some numbers.
Okay, so the app now has 35 million registered users. That's up 27% year over year.
Wow, 35 million. And that user growth, I assume, drives engagement, which is where the real value is, right?
It is. The engagement numbers, trailing four-quarter transaction volume, grew 27.9% year over year. That's 4.54 billion transactions.
Billion.
And the value carried on the platform was RP 4,257 trillion. That's up 10.4% year over year. I mean, the scale is just enormous.
And that connects back directly to the cost of funds story, doesn't it? This is how they build up those cheap deposits organically over time.
Exactly right. The platform is averaging, get this, 24,800 new digital account openings per day.
Per day.
Per day. And these are high-quality, low-cost CASA deposits, current accounts, savings accounts. Basically, money the bank pays almost nothing for. Their overall CASA ratio is now super strong at 69.3%. So this digital momentum, it gives them the real structural competitive edge for gathering cheap deposits and generating fee income. It lessens their reliance on those traditional expensive funding channels.
Right.
The ones that RP 55 trillion placement was kind of a temporary Band-Aid for.
Right. Makes sense. Okay, shifting gears slightly, let's quickly touch on operational costs, OPEX, because there was a noticeable spike in Q3, particularly employee costs, and that caught some analyst attention.
Yeah, management was pretty quick to address that. They basically explained it was down to some one-off expenses and internal strategic activities happening in the third quarter. But, what really matters is their guidance for the future.
And what was that?
They expect OPEX to normalize in Q4.
Yeah. And
they're targeting a really aggressive goal for next year. 0 OPEX growth for the entirety of 2026.
Zero growth.
Zero growth. That kind of planned cost discipline, well, it shows they're serious about protecting the bottom line from the inside, even if margins get squeezed from the outside.
Okay. And finally, on the fundamentals, capital strength. Given all this pressure and the need for flexibility, how are their buffers looking?
Extremely solid.
Yeah.
Just to define a couple terms for you listening, the capital adequacy ratio, CAR, it's high at 20.1%.
Yeah.
And the CET1, Common Equity Tier 1, that's the highest quality buffer, is at 18.9%.
Very healthy.
Very. And maybe most importantly for investors right now, their NPL coverage, the amount set aside for potential bad loans, is extremely robust at 271%. That massive buffer gives them a lot of flexibility for future credit growth, any regulatory changes, and crucially for shareholder actions.
Right, and that strong capital position brings us neatly to the shareholder signals. Because even with that year-over-year profit drop, management seemed keen to talk about supporting total returns.
They were. Management explicitly reiterated they're comfortable maintaining a 60% dividend payout ratio. That's despite the profit reset this year.
Which is a strong signal.
It is. And furthermore, they confirmed their share buyback authorization is still active, running through March 2026. So that signals they have two immediate levers they can pull, dividends and buybacks, to try and boost total returns for investors, which is clearly a priority, given the underlying operational strength.
Okay, but the elephant in the room remains that policy risk. Analysts on the call, they kept pressing management, right? How will you defend NAMEM if the government successfully pushes for lower loan yields across different segments, especially since they gave you that RP 55 trillion, which kind of came with strings attached?
Yeah, they did press. And management's answer, really, it rests entirely on those two levers we've been discussing. First, the continued strategic decline in the cost of funds, hoping the benefit from the government placement lasts a while, but relying more and more on the structural benefit from Livin. And second, aggressive digital monetization, getting more fee income from that platform.
So it's cop down, digital fees up.
That's the plan. The market reaction, though that spike, then the fade. It sort of shows investors maybe believe the cuff story can work in the short term.
But they're nervous.
But they're definitely anxious about the speed and depth of that inevitable policy-driven loan yield cut.
Okay. This feels like a good point to transition to our This Is Not Financial Advice segment, where we put on our analyst hats for a moment, look at the numbers, and pitch a maybe slightly out there but plausible idea. Just for discussion, remember, not for your actual portfolio.
Absolutely not financial advice.
Yeah.
So the call basically confirms BMRI is structurally sound, solid operations, good management. But it's trading at pretty depressed valuations. That policy risk is weighing on it. The 52-week return is currently negative 38.8%.
Ouch.
Yeah. So we see a potential opportunity here. We're calling it the synthetic capital release play.
Oh, okay. Intriguing name. Tell me how the math works on that one.
Well, it all hinges on that over-provisioning we talked about. The core thesis is that BMRI is arguably structurally over-reserved compared to its peers and probably its own historical need.
Because their bad loans are so low.
Exactly. We said their NPL ratio is just 1.03%, right? But their NPL coverage, the cash buffer against those bad loans, is a massive 271%. An analyst on the call even mentioned 230% as being a pretty robust target. So the bank is essentially sitting on excess capital that's kind of locked up in these provisions.
Okay, so they have maybe too much capital protecting against a risk level that, based on their actual performance, isn't really there right now. How does that become a trade idea?
The action, the theoretical play, is to go long BMRI. The anticipation is that management will eventually decide to use that excess capital cushion.
How?
Supported by that active buyback authorization, they have until March 2026, and there are already ample capital buffers, like the 20.1% CAR. They are perfectly positioned to aggressively execute share buybacks, potentially well beyond what they need just for funding normal credit growth. They could effectively release some of that, synthetically trapped capital via buybacks.
Ah, I get it. And because buying back shares reduces the share count.
It massively boosts earnings per share, the EPS,
Yeah.
without needing core profit to grow nearly as fast. So the buyback essentially acts like a synthetic dividend yield enhancer for the stock. It could help override those short-term margin pressures everyone's worried about because of the policy stuff.
Okay, and what's the catalyst you'd be watching for?
Well, any signal from management, really. Any hint that coverage ratios might be allowed to drift down a bit, maybe towards that 230% mark mentioned, or even simpler, just seeing a marked acceleration in their actual buyback activity in Q4 or early next year, that would signal they're pulling this lever.
And the risk?
The risk is the same one hanging over everything, that policy intervention forces loan yields down so fast and so hard that even their smart cove management and potential buybacks can't keep pace. Policy risk trumps all potentially.
Fascinating idea, though. Really hinges on management using that balance sheet flexibility specifically to boost shareholder returns.
Yeah.
Okay, wrapping up this deep dive then. The key takeaway seems pretty clear. BMRI is successfully fighting off short-term margin pressure. They're using smart funding optimization, especially that RP55T placement for now, coupled with really superior and probably more structural digital execution through the massive scale of Livin.
Yeah, that initial price spike after the call. That suggests the market kind of believed the temporary cough story could work. But the fay afterwards shows the deep anxiety about the policy risk just won't go away.
So the provocative question for you, the listener, to maybe think about as you look ahead is this. Will the sheer scale and the low-cost funding coming from Livin finally generate enough fee income and enough cheap deposits in Q4 and into 2026 to fully neutralize that government pressure on loan yields?
Or is significant margin compression just inevitable next year, especially once the sugar rush from that short-term liquidity placement wears off?
That's the multi-trillion rupiah question, isn't it?
Indeed it is. Something to mull over as you review your own sources. Thanks for joining us on this deep dive.